Every empire that prints money believes it can print time. They can't. America learned this the hard way. Not once, 3 times. Each time, the same promise, each time. The same collapse, each time. A different name for the same mistake. This is the story of how a nation discovered it could manufacture dollars faster than value. And what happened when the world stopped pretending those two things were the same? It begins in 1971. August 15th, a Sunday night. President Richard Nixon appears on television. The announcement lasts 11 minutes. He suspends the convertibility of dollars into gold. The Bretton Woods system dies in a single broadcast. For 27 years, the global economy had rested on one promise: $35 could be exchanged for 1 ounce of gold. Any nation holding U.S. currency could make that trade. It gave the dollar weight, substance, limit. Nixon ends it. The reason is simple. America has been printing more dollars than it has gold to back them. The Vietnam War costs $200 billion. The Great Society programs cost more. Foreign governments notice. France begins converting dollars to gold. Other nations follow. The U.S. gold reserve starts draining. Nixon closes the window. He calls it temporary. It never reopens. Overnight, the dollar becomes a promise backed by nothing but faith. No metal, no limit, just the word of a government that had already broken the previous agreement. The result arrives within 2 years. Inflation begins creeping upward. Oil prices quadruple in 1973. By 1980, inflation reaches 14%. Interest rates hit 20%. The purchasing power of a dollar falls by half in a decade. But something else happens. Something no one predicts. The world keeps using dollars anyway. This pattern is not new. It is ancient, and it always follows the same sequence. Step 1. A power realizes it can create money without creating value. Step 2. It does so. Quietly, then boldly, then recklessly. Step 3. Confidence breaks. Step 4. The system resets. Sometimes through reform, sometimes through ruin. Rome understood this. In the year 60 for AD, Emperor Nero begins debasing the denarius. The silver content drops from 100% to 90%. He needs funds for reconstruction after the Great Fire. He finds them by diluting the currency. His successors continue. By 100 AD, the denarius is 85% silver. By 200 AD, it is 50%. By 270 AD, it contains almost no silver at all, just a thin coating over bronze. Prices explode. A measure of wheat that cost half a denarius in 200 AD costs 200 denarii by 301 AD. Emperor Diocletian responds with price controls. He issues the Edict on Maximum Prices, fixing the cost of over 1,000 goods and services. The penalty for violation is death. It fails. Merchants stop selling. Goods vanish from markets. The black market thrives. The edict is abandoned within a year. Rome does not collapse because of barbarians. It collapses because the currency collapses. The legions refuse to fight for worthless coins. The tax system breaks down. The state fragments. By 476 AD, the Western Empire is gone. The currency died first. France repeats the pattern in 1716. The Mississippi Company is created by John Law, a Scottish economist. He convinces the French government to let him issue paper currency backed by future profits. From trade in Louisiana, the currency is called billets d'état. It is supposed to be backed by the wealth of the New World: gold, tobacco, land. Speculation surges. Shares in the Mississippi Company rise 20-fold in a single year. Fortunes are made on paper. The problem is that Louisiana contains almost nothing. No gold mines. No vast riches. Just swamps and a few thousand settlers. The wealth does not exist. But the currency does. By 1720, people begin demanding redemption in gold and silver. The bank cannot pay. Panic spreads. Love flees France. The currency becomes worthless. Thousands of investors are ruined. The monarchy's credibility never fully recovers. 50 years later, France tries again. During the Revolution, The government issues assignats, paper currency backed by confiscated church lands. The idea is that the land will give the currency value. At first, it works. Then the government prints more and more. By 1795, the assignat is worth less than 1% of its original value. Bread riots break out. The currency is abandoned in 1796. France returns to metal coins, to experiments, to collapses. One lesson ignored. Germany provides the most extreme case. After World War I, the Treaty of Versailles imposes reparations of 132 billion gold marks. Germany cannot pay in gold. It pays in paper marks. To generate those marks, the Reichsbank begins printing. In 1919, $1 equals 8 marks. By 1922, it equals for 100 marks. By January 1923, it equals 18,000 marks. By November 1923, it equals for 0.2 trillion marks. A loaf of bread costs 428 marks in 1923. 6 months later, it costs 1,200 marks. By September, it costs 2 million marks. By November, it costs 200 billion marks. Workers are paid twice a day. They spend the money immediately. Waiting even hours means the currency will be worth less. Restaurants change prices. Between courses, people use marks as wallpaper. Children build blocks out of bundles of cash. It is cheaper than buying toys. The hyperinflation ends when Germany introduces the Rentenmark in November 1923. 1 Rentenmark equals 1 trillion old marks. The currency is backed not by gold but by land and industrial assets. The insanity stops, but the damage is done. The middle class is wiped out. Savings vanish. Pensions become worthless. Trust in government evaporates a decade later. That mistrust helps bring the Nazis to power. That confidence was the first crack. America does not experience hyperinflation in the 1970s, but it experiences something close. Stagflation. High inflation combined with economic stagnation. It is supposed to be impossible. Classical economic theory says inflation comes from growth, stagnation comes from contraction. You cannot have both, but America has both. From 1973 to 1982, inflation averages 8.8% per year. Unemployment rises above 10%. GDP growth slows to near zero. The Federal Reserve under Paul Volcker responds by raising interest rates to 20%. The economy enters a severe recession, but inflation breaks. By 1983, it falls below 4%. The cost is brutal. Businesses fail. Unemployment soars. Home foreclosures spike. But the dollar stabilizes. The lesson appears to be learned. It is not. In 2008, the system breaks again. Lehman Brothers collapses on September 15th. Credit markets freeze. Banks stop lending. Trillions of dollars in wealth vanish within weeks. The Federal Reserve responds with something new. Quantitative easing. The central bank begins purchasing assets directly, mortgage-backed securities, treasury bonds, corporate debt. The goal is to inject liquidity into the system. The purchases begin in November 2008. The Federal Reserve buys $600 billion in assets, then another $600 billion, then $1.7 trillion. By 2014, the Fed's balance sheet has grown from $870 billion to $4.5 trillion. This is not money printing in the literal sense. The Fed is not running physical printing presses, but the effect is the same. It is creating dollars electronically. The currency supply expands massively. Economists argue this is necessary. Without intervention, the financial system will collapse. The Great Depression will repeat. The Fed is acting as lender of last resort. But something else happens. Asset prices surge. Stock markets hit record highs. Real estate rebounds. Wealth concentrates at the top. Those who own assets get richer. Those who do not fall further behind. Inflation remains low. The official consumer price index rises only 1 to 2% per year. Central bankers declare victory. The system has been saved without triggering inflation. This conclusion is wrong. The inflation is there. It is just not showing up in consumer goods. It is showing up in assets, stocks, bonds, real estate. The wealth gap explodes. In 1989, the top 1% of Americans owned 23% of total wealth. By 2019, they own 32%. The money does not disappear. It flows upward. Then comes 2020. The pandemic hits. Governments worldwide shut down economies. Unemployment spikes to levels not seen since the Great Depression. Businesses close. Supply chains break. The response is unprecedented. The US government passes the CARES Act in March 2020. It authorizes $2.2 trillion in spending, direct payments to citizens, expanded unemployment, benefits, business loans. The Federal Reserve adds another $3 trillion through asset purchases. More stimulus follows. The Consolidated Appropriations Act in December 2020 adds $900 billion. The American Rescue Plan in March 2021 adds $1.9 trillion. In total, the U.S. spends roughly $5 trillion in pandemic relief. The Federal Reserve expands its balance sheet from $4.2 trillion in February 2020 to $9 trillion by April 2022. This time, inflation does not stay in assets. It spreads to consumer goods. By 2021, the Consumer Price Index begins rising. By 2022, inflation reaches 9.1%, the highest rate in 40 years. Gas prices double. Grocery bills surge. Housing costs skyrocket. Rent increases by 20 to 30% in major cities. The average home price rises from $320,000 in 2020 to $420,000 in 2022. The Federal Reserve responds the same way Volcker did. It raises interest rates from near zero in 2021 to 5.33% by 2023, the fastest increase in for decades. The pattern repeats again.